Well, another volatile week on Wall Street. The Dow Industrials plunged more than 1,100 points. But there's a lot that's coming up that could really change market direction. Let's bring in Brian Giuliano. He's Vice President of Portfolio Management at Brandywine Global. And David Nicholas, President of Nicholas Wealth Management. Guys, good morning.
Good morning.
All right, Nicholas, we could look backwards or maybe we can look forwards. You know, there's a really great piece about the fact that December is usually a good month for stocks, but this month is really off to a rough one. And a lot of that, of course, is the issue with China and the issue with the United States and the trade deal confusion. Do you feel any better this morning than you did on Friday about the trade deal with China?
You know, unfortunately, I don't. I don't think I was hoping for a year-end resolution on this trade deal, but I actually think we might not see it. Obviously, given the events of the arrest that we saw here recently, I don't think we're going to see anything maybe until the first quarter of next year. So I think this heightened volatility that we've seen, I think we're in the seventh inning for the markets. We know we're getting close to the end. We just don't know what the outcome will be. So sadly, Cheryl, I don't think we're going to see an outcome by the end of the year.
Yeah, Brian. I mean, he's bringing up the issue of volatility, and we've had a lot of volatility over the last few weeks, really going back to October. And it's not just, you know, worries about China, but also worries about a global recession. But if you look at the economic data coming out of the United States, especially, it doesn't really point to that. Maybe Germany's got some weakness. We're concerned about Brexit. But overall, do you really think that we've got this global recession coming like the bears are saying we do?
So I think global recession is too strong of a term, but it's clear that U.S. economic activity is set to slow going into next year. Look at weakness in autos, look at weakness in housing. You've seen dollar strength negatively affecting multinational earnings. So it's clear that there are some headwinds out there. The Fed has talked about being more data dependent going forward. I think that's a very good thing, but the Fed might be a little bit more tight than they think, and not enough people are talking about quantitative tightening, the reduction of the balance sheet. That's going on behind the scenes here. I think that's causing more volatility. So when you've got the potential for U.S. growth to slow into next year, you've got question marks surrounding Fed policy, and to the point we were just talking about a minute ago, you've got all these concerns around trade.
Yeah.
And with trade, is it about trade deficits? Is it about Chinese companies stealing U.S. technology, U.S. intellectual property?
Can they stop
or is it about a broader Washington policy around containment of Chinese growth?
And
so
there's something
the market's
else
digesting a lot.
And David, there's something else here, and that is that we were just showing the 10-year. We're still below 3% on the 10-year. And that was a big worry for the market last week, was the spread between the short and the long bond and how tight things got. Is that still a worry for you? Was that ever a worry for you? Because, again, the word recession comes up when you look at the spreads on the treasuries.
Yeah, you know, the inversion in the yield curve is kind of the thing I think a lot of people are looking at right now. I think this time will be different. I don't think we're going to have to put as much weight in an inverted yield curve, because really, if you look at real rates, we're about 0% right now for real rates. So even if the curve does invert, I'd be hard-pressed to think that a 0% rate environment is too much for the economy to handle. So I think even if it inverts, the market should still rally, 9 to 12 months before any impending recession.
You know, Brian, also, if we look at the average investor right now, they're probably a little bit nervous about the year-end picture for them. Is there any catalyst for you that you think could change the picture for markets as we approach the end of 2018?
Yeah, well, I think some of the things we just talked about a minute or two ago, if we can get a little bit of more clarity on Fed policy, on trade relations, I think that could go a long way. But going into 2019, I think some of the best opportunities in markets might be in international equities, or even in emerging markets, equity space, or even in the debt space. Because if you think about what's gone on this year, you've had U.S. growth accelerate, the rest of the world has slowed. I think you're going to see a trading of places next year where overseas growth starts to stabilize and U.S. slows a little bit.
I'm glad you brought up the Fed. It's just adding to the wall of worry. It's a bigger wall than we're talking about at the border at this point. Brian and David, thank you guys very much for being here. Appreciate it.
Thank you.
Thank you.